US government bond yields are soaring. There's a big problem, and it's coming out of Japan, where their bond market continues to absolutely melt down, risking not only trillions of capital unwinding in the yen carry trade, but a capital repatriation event causing trillions in US stock and bond sales. So there's a lot going on, major moves in the US bond market, major moves in the Japanese government bond market as well. A lot of pretty large risks on the horizon. So I wanted to address them in this video, specifically looking at the interlink between Japan and the US and try to explain it best I can. So here's the 10-year JGB yield right now, almost at 2% for the first time in decades. Now, here is the root of the problem. Japan has run a current account surplus. Remember, the vast majority of that is balance of trade. They run a trade surplus. We can see recently has been as high as almost 5% of GDP. They run a very, very strong economy, export-driven economy. Well, the other side of that coin means that they must run a capital and financial account deficit. Remember, it is simply an accounting reality. If you run a trade surplus, you must run a capital and financial account deficit. You must be a creditor to the rest of the world. Well, Japan has been. In blue, we can see their foreign exchange reserves. Now, think of this as the country's national savings, right? If you are exporting more value than you are importing, well, you are accumulating savings. You are accumulating wealth or assets. These in blue are those assets, mainly U.S. Treasuries. About 1.1 trillion of this 1.2 trillion is in U.S. Treasuries. Now, remember, if you're in Japan, if you're the Bank of Japan, and you own a 2-year U.S. Treasury, you own a dollar. You own an interest-bearing dollar. You are long on the dollar. So as we get into the yen carry trade here, remember that point. So here we're looking at the Japanese government bond market, and of course in pink is zero. So what we can see is that for years they had negative interest rates. What that meant is that money, the yen in particular, was free. Literally, the cost of money was negative, meaning that everyone was incentivized to go out and borrow in yen. But the problem was that the yen was weakening quite significantly. So here we're going to look at the yen dollar. This is not normally how it's displayed, but I think it's more intuitive to look at it this way. And we can see that the yen weakened pretty substantially. So what that meant is if you were borrowing in yen at negative interest rates or maybe zero, you were incentivized to sell the yen, putting more downward pressure on the yen, and buy a stronger currency, in this case, the dollar. In the yen carry trade example, it was the dollar. People would borrow in yen, sell the yen immediately, buy dollars, and then you get positive carry if you want to go use those dollars to buy U.S. Treasuries or stocks, to some degree in real estate as well. So this was a huge driver of liquidity, globally speaking. There was basically a money printing machine called the yen carry trade. And it's important to point out a lot of that yen carry trade, at least the last time it unwound in summer of last year, it came out reporting that a lot of that trade, the yen carry trade, where people were shorting the yen, selling the yen to buy the dollar to buy U.S. assets, a lot of that was currency unhedged, meaning that if the yen started to strengthen, they were in big trouble. Now, here we're looking at interest rate differential relative to the strength of dollar yen. And what we can see is going back to April, the U.S. 2-year government bond yield relative to the Japanese 2-year has actually contracted. So the relative premium or attractiveness of the yen carry trade has weakened. We can see that with the white line going from about 3.3% premium to buy a U.S. government bond than a Japanese one, down to just 2.5% and falling. Despite that, however, what has happened with the currency? Well, the dollar has strengthened and the yen has weakened. Remember the two ways of saying the same thing in this case. Here we're looking at the 10-year interest rate differential between Japan and the U.S. And again, the same story is true, which is the relative attractiveness of U.S. government bonds is falling, meaning the attractiveness of that yen carry trade is falling. Now, yeah, the dollar has strengthened relative to the yen, so you're still picking up positive carry. And at this point, you still get 2.2% more interest, more yield on the US 10-year government bond than you do the 10-year government bond. But that spread is narrowing. That interest rate differential is narrowing, making the attractiveness of that very large liquidity driver, the yen carry trade, less attractive. Now, getting to their stock market. So here we're looking at the Nikkei 225. You can think of this as the S&P 500 for Japan. And then in blue, we're looking at dollar yen exchange rate. Now, because Japan runs such a large current account surplus, they are an export driven economy. You want actually a weaker currency because a strong currency actually means that your exports become less competitive on the global stage. This is the problem the US has run into. We have a vastly, fundamentally overvalued currency. Therefore, we must run a trade deficit because our goods are not competitive on the world stage. We have too strong of a currency. While in Japan, they want a weak currency. And we can see maybe not as strong of a correlation as with the interest rate differential here, but we do see a pretty modest correlation, which is as the dollar strengthens or the yen weakens, we can see strength in their stock market. However, what we are seeing recently is that their stock market has caught a pretty significant bid year to date, by the way. But recently, we have seen that their stock market has rallied pretty significantly, despite the fact that the dollar has weakened. Put another way, the yen has strengthened. Now we're going to look at fundamentals. So here is a growth differential, and then the 3/4 rate of change of dollar yen. Yeah, there's some driver here, fundamentals, right? If the US is experiencing stronger growth, yes, you might expect stronger US dollar. However, the correlation here is not as strong. I would point to the interest rate differential, which again, the 10-year is going to be driven much more by growth and inflation, nominal growth expectations. So I would point to the 10-year interest rate differential rather than a GDP differential, growth differential in that way. Here we're looking at the US bond market. And what do we see for the past couple of days? Bond yields, or past week or two, bond yields have been moving sharply higher, especially at the long end of the yield curve in the 30-year government bond here. Now, remember, as the bond yield is moving higher, the value or the price of the bond is moving lower, in this case, to the lowest level going back to September. Now, why is this happening? Well, again, remember that yen carry trade relies on U.S. government bonds being more attractive than Japanese government bonds. Japan is the one that runs a very large current account surplus, and that is a creditor. More value is accruing to them, and therefore they must put that value into foreign markets. Well, the attractiveness of U.S. government bonds is declining. Now, we have seen a dollar strengthening, but the other problem here is that the yen weakening right now at about 156. The Bank of Japan has come out, the Ministry of Finance has come out and said that, look, we cannot tolerate too weak of a yen because it results in too much inflation. Therefore, we will intervene. We're not going to tell you exactly where, but we will sell those US dollar assets, those US treasuries, and then sell the dollar to buy the yen to artificially strengthen our currency if it starts to get too weak. Well, of course, they own $1.1 trillion of US treasuries. That could cause some pretty significant problems in the US bond market. But not only that, the capital repatriation event. So what is that? That is where Japanese firms, individuals, banks might go, you know what? We put our money in US government bonds because our government bonds gave us basically no interest rate for many, many years. So we had to go elsewhere like the US. But now we are starting to get interest rates that are somewhat appealing here in Japan. So we are going to sell the US Treasury, or if they bought US tech stocks, for example, sell the tech stocks to then sell the dollar, because, right, these are dollar denominated assets. So then they would have dollars. Well, you don't want dollars. You want to buy a Japanese asset denominated in yen. So you sell the US Treasury, then sell the dollar to buy the yen, to then buy the government bond, which would bring the yield lower. We are not seeing a stabilization in Japanese government bond yields yet, but that is what a capital repatriation event could do. And again, remember, trillions over many years, if not decades, going back to the 1980s, trillions has been stashed in US dollar denominated assets. Now, to take a look at the yield curve, I think that there's something notable going on here. Down below, we can see the 10-year minus Fed funds. That particular spread is at the highest level going all the way back to January. And of course, we have seen a general steepening of the yield curve, especially after Kevin Hassett, kind of a stooge of the administration, was floated as the next Fed chair. We have seen a bear steepening of the yield curve as investors price in that fiscal dominance and that basically emerging market like phenomenon of making the Fed a political organization, making the central bank a political organization. Generally, we know that they're headed towards negative real yields where government bond yields will be below the inflation rate. Well, that is very good for gold, as we went into in our prior video about QE and how it is coming back and the effect that it'll have on markets. So anyways, hopefully that was helpful. A couple risks to be aware of, maybe to help explain some of the recent moves we have seen in the U.S. bond market. However, again, there are also drivers here in the U.S., like Kevin Hassett being named as a potential Fed chair. And of course, the Bank of Japan, it should be noted, has a interest rate decision coming up where they are going to decide whether or not to hike interest rates. Well, if they come out and hike interest rates, again, only at 0.5% right now, if they come out and hike interest rates, that could cause a rapid strengthening of the yen, which of course could unwind the multi-trillion dollar large yen carry trade. So a lot of dynamics to be aware of. Hopefully that was helpful, and I'll catch you in the next one.